Assalamualaikum and salam sejahtera to all of you. So welcome to topic 2, Introduction to Conceptual Framework. Okay, so out of many items that we discuss in Conceptual Framework, okay, for ACC 106, we are going to focus on the qualitative characteristic of the financial information. Alright, so the qualitative characteristic of the financial information can be divided into fundamental qualitative characteristic and enhancing qualitative characteristic. In addition to whatever that we discuss from the conceptual framework, we are also discuss on the accounting assumption and concept. Alright, so what are the fundamental qualitative characteristic? Okay, so they are relevance and faithful representation. So we must make sure that when we prepare the financial statements or when we provide the financial information, okay, either in the statement or outside the statements, alright, the information must be relevant to the users of the financial um, information, alright, and then it must be faithfully represented. Alright, and then for the enhancing qualitative characteristic of the financial information, we must make sure that okay, the financial information that we provided are comparable, verifiable, timely, and understandable. Alright, so that it would be useful to be used by the users of the financial information when they are making the decision. Okay, in addition to qualitative characteristic, okay, of the financial information discussed in the conceptual framework, okay, when we prepare the financial statements, we must also okay have this assumption, okay, follow this assumption and concept, which are the going concern, historical cost, economy entity, and money measurement. All right. Alright, before we proceed with the discussion on the qualitative characteristic of financial information, so let's look at what is a conceptual framework. So conceptual framework is a framework, okay, uh, issued by Malaysian Accounting Standard Board MASB. So this is for Malaysia. Alright, so the conceptual framework set out the concept that underlie the preparation and presentation of financial statements for external users, meaning that when you prepare the financial statement, it is not based on how we like the financial statement to be prepared, how we want to present the items, okay, in the financial statements. No, it does not depend on us. Okay, we have concept, we have to follow the guideline, okay, which set out by the conceptual framework. However, if the conceptual framework is in conflict with the accounting standard, then we have to follow the accounting standard. Okay, so the purpose of conceptual framework is to guide the preparation and presentation of financial statement in accordance with MFRS framework. All right, so we did not simply prepare. Okay, we did not simply prepare the financial statement. Okay, we have to follow the guidelines, all right, set out by the conceptual framework and also from the accounting standard. Okay. Alright, so when they talk about when the framework talk about the qualitative characteristic of useful financial information, what is it that they want to focus? Okay, so when they talk about the qualitative characteristic, they are looking or they are identifying the types of information that are likely to be most useful to the existing and potential user for making decision about the reporting entity on the basis of information in its financial report, okay, which is the financial information. All right, okay, so the reporting entity, meaning that if we want to analyze a company, let's say for example Tenaga Nasional Berhad, so we must make sure that okay, we want to make sure that the information provided by this reporting entity, which is TNB, are useful to the existing and potential users of TNB. Okay, because they need to make a decision, okay, especially for the investor. So they need to make a decision whether to hold the investment, whether to sell their investment, or for the potential investor whether to buy the investment. Okay. All right, and then to apply to financial information. So these qualitative characteristics are to be applied to the financial information provided in financial statements as well as to financial information provided in other ways, meaning that not necessarily on the face of the statement. Okay, what about the other financial statement of the company, of the reporting entity? Okay, so we cover all the financial information. Okay, we must make sure that they met this qualitative characteristic. Okay, and if financial information is to be useful, all right, so for the financial statement, financial information to be useful, it must be relevant and faithfully represent what it purports to represent. Okay, so these two are the fundamental qualitative characteristics. And the usefulness of financial information is enhanced if it is comparable, verifiable, timely, and understandable. So these represent the enhancing qualitative characteristic. Okay, so in the following slide, we are going to look in detail of this qualitative characteristic. Okay, so now we are going to first look at the fundamental qualitative characteristic. Okay, so the first fundamental qualitative characteristic is the relevance. What does it mean by relevance? It means that the financial information that we provide, okay, to the users, okay, that financial information is capable of making a difference in the decision made by users, provided that, okay, so for that information to be relevant, to be able to make a difference, okay, in the decision making process of the user, okay, that information must have either one or both of predictive value or confirmatory value. What is a predictive value? Predictive value meaning that we can use the financial information to predict the future. Okay, we can use the financial information, okay, as an input to predict the future. Okay, and allow the user to make their own prediction. Okay, all right, what about the confirmatory value? Confirmatory value meaning that the financial information that we provide is able to provide feedbacks or give feedback or to confirm, okay, or to change the previous evaluation. Okay, because in the past, okay, we may come up with our own prediction. All right, and then whatever information, okay, related to financial year end, meaning that the financial information, the information for the current year, okay, is able to confirm our previous prediction, whether we predict correctly or not, okay, or whether we need to change the prediction, okay, previous evaluation, meaning that we need to change the process, okay, to make the prediction. Okay, all right, so it provide feedback, okay, whether it can confirm or change, okay, the previous evaluation. Okay, so let's look at one example. Okay, so one of the most common financial information that we find in the financial statements is sales. Okay, sales. All right, so sales is relevant because why? Because it has both predictive value and confirmatory value. Okay, it may have either one, okay, or both. All right, so predictive value, okay, so predictive value using the actual sales of this year, okay, using the actual sales of this year, we can predict next year sales. We can predict next year sales. All right, and then the sales, okay, the sales of this year, the actual sales, okay, can be compared with the predicted sales that we made last year. Okay, before beginning of the year, okay, we make a prediction of this year's sales, right? Okay, and then at the end of the year, okay, we can get the amount for actual sales. So we are going to compare. Okay, we are going to compare these two. Okay, the one that we predicted at the beginning of the year and the one that we have at the end of the year, the actual sales. So we're going to compare. So from this comparison, we can either confirm, okay, or we need to change the previous evaluation, okay, whether the prediction is correct, okay, whether the prediction is far off. Okay, so using that information, okay, okay, so any difference between actual and predicted sales can be used to correct or improve the process in making new prediction. Okay, so we can use that information, okay, to improve our previous evaluation. We improve the process, okay, because when we make a prediction we have to have a certain process, right? Okay, so we have our own method, so maybe we need to change the method. Okay, so we need that the sales are relevant because why? Because it has both predictive value and confirmatory value. Okay, however, okay, because we said that the financial information um, the financial information is relevant when it is able to make a difference, okay, capable of making a difference. Okay, but still, okay, why certain information might not capable of making a difference? Okay, it could be due to the materiality of the item. Okay, so the information is material, the information is capable of making the difference. Okay, if we omit the information, we misstate the information, it could change the decision of the user. Okay, it could influence the decision of the users. Okay, make on the basis of financial information about the reporting entity. Okay, however, there are information which are relevant. Okay, contain both the predictive value, confirmatory value, but okay, the omission or the misstatement of the item, okay, may not affect the or may not influence the decision of the users because of its materiality level. Okay, so in accounting, that information may be relevant, but okay, but still, this information then can be grouped into a material information or immaterial information. All right. Okay. However, the information that we usually present on the financial statements are relevant. Okay, because they have the predictive value or confirmatory value. Okay. All right. Next. So the next one is faithful representation. So this is the second fundamental qualitative characteristic. Okay, so for the financial information to be useful, it must faithfully represent the phenomena that it purports to represent, meaning that you have to show everything. Um, you cannot be biased, okay, and then decide on which information to be disclosed and which information is not to be disclosed, okay, in the financial statement. Okay, that is not right to do that. Okay, so to be a perfectly faithful representation, a depiction would have three characteristics. So the first one, okay, the financial information must be complete. All information necessary for a user to understand the phenomena being shown, including all necessary description and explanation. Okay, we do not simply show the figures, show the number, but we have to support with the notes to the financial statement to explain how do we decide, to explain the policy, okay, or to explain maybe there are special circumstances that happen that year that could affect the way we present the financial information. Okay, we have to provide all the information. Okay, must be complete. Okay, so that the user understand what happened. Okay, neutral. Okay, this is what I said just now. You cannot choose, okay, you cannot be biased, you have to be neutral, no bias in the selection or presentation of financial information. Okay, number 3, free from error. Okay, free from error, no error or omission in the description of the phenomenon, meaning that in every transaction that happen, you must make sure that you report them correctly without any error or omission. Okay, and no error in the selection and application of the process used to produce the reported information. Okay, no error in the selection and application of the process used to produce the reported information. Okay, not only we have to make sure that the financial statements, the figures, the numbers, the items, okay, are free from error. Okay, we must also make sure that the process, okay, the process to produce the financial information are free from error. Okay, are free from error. All right, so if you have these two, relevance, okay, and faithful representation, so you meet the first fundamental qualitative characteristic. Okay, right. So next we are going to look at the enhancing qualitative characteristic. Okay, so the first one is the information must be comparable. Comparability. It means that the users, okay, able to identify and understand similarity in and differences among items. Okay, they are able to understand when they put a comparison require at least two items, meaning that when you put side by side, okay, let's say for example, the financial information of the same reporting entity but of different years. Okay, so when they put side by side, okay, they are able to see the similarity and the difference of the items and they understand. Okay, all right. Comparability, however, does not equal to consistency. Comparable meaning that we are able to compare. Okay, consistency is where the same methods, okay, for the same items, okay, either from period to period within a reporting entity or in a single period across entity, meaning that we are applying the same method, okay, for the same item, okay, from one period to another period, okay, or in a single period, okay, all entities, let's say for example, within the same industry, they are applying the same thing. Okay, so that is consistency. Okay, comparability, however, also not equal to uniformity. Okay, for information to be comparable, okay, like things must look alike and different things must look different. Okay, if we want to compare apple with apple, okay, we do not compare apple with the durian, let's say for example. Okay, compare apple with apple. Okay, like things, okay, similar things must look similar and different things must look different. Okay, we cannot have almost similar but not similar, okay, which can be confusing to the users. All right, so apple compare with apple, let's say for example asset compare with asset, and and then both entity also has the same definition of asset. All right, has the same definition of asset by referring to the standard or the conceptual framework. Okay, then we are able to compare. Okay, all right. Okay, the information also, for the information to be useful, it must be verifiable. Verifiable meaning that different knowledgeable and independent observers, okay, different people, okay, with a knowledge of the items, okay, of the accounting, let's say for example, independent observers, okay, could reach consensus, although not necessarily complete agreement, that a particular depiction is a faithful representation, meaning that different people, when they look at the same statement, okay, they come to the conclusion that, okay, this financial statement is complete, okay, is faithfully represented, all right, is free from errors. Okay, different people, they come to a same conclusion. Okay, all right. Okay, direct verification, so we can also verify the item, okay, through direct verification means verifying an amount or other representation through direct observation. Let's say for example by counting the cash. Let's say for example in the financial statement it is reported that cash in hand is 100 ringgit. So you are able to count that 100 ringgit. You are able to see that 100 ringgit kept at the office. Okay. Indirect verification means checking the inputs to a model, formula, or other techniques, and then recalculate the outputs using the same methodology. So this is where I said just now that if you cannot predict using the actual sales, there are other ways to predict. Okay, because sometimes we may use a model, a formula, or other techniques to make a prediction. Okay, so indirect verification here meaning that if you are not able to make a direct observation, you cannot go to the premises, you cannot see the items. Okay, you cannot personally go and make a direct observation, for example. Okay, but still you can confirm the value using indirect verification, using the model, using the formula, or other techniques. Okay, and then you recalculate. So when you recalculate, by having this much input, at the end of the day you have this much output. Okay, all right, so we are able to verify. Okay, all right, next, timeliness. Okay, the information, okay, to be useful, it must be timely. Timeliness meaning that information is made available to decision makers in time, meaning that when they need the information is there, okay, to be capable of influencing their decision. Okay, let's say for example, if I need the information today, okay, to be used in today's meeting, let's say for example, okay, so I need it today. Okay, so that information is useful if I can have that information today for my meeting. If let's say for example, I have my meeting today and then you provide me the information the following days, okay, it could be tomorrow, 2 days after that, a week after that. Okay, what do you think? Do you think the information is still relevant for me, okay, to make the decision? Okay, it is no longer relevant. Okay, it is not timely. Okay, timely meaning that when we provide the information, okay, the information is in time, okay, to be capable of influencing the decision of the financial information users. Okay, so make sure, so that's why we need to make sure that we can produce the information as quick as possible, but with no errors or omission. Okay, all right, so next, I think this is the last one for enhancing qualitative characteristic, understandability. Okay, understandability meaning that you classify, okay, characterizing and presenting information clearly and concisely, okay, makes it understandable. Okay, so when you learn on the accounting process, okay, so the accounting process begin with classifying. Okay, so why do we need to classify? After the classifying, we record. Okay, but the first thing that we do is to classify, because we want to make sure that everything is in order. This item is an asset item, this item is liability item, this item is expense revenue related to honest equity. Okay, so um, at the end of the day, okay, people would understand, okay, from our presentation of financial statements. Okay, so this what happened during the year. Okay, this is how we manage our company. Okay, you are able to show how efficient you are. Okay, so the first step is to classify. Why do we need to classify? Because at the end of the day, we want to make sure that, okay, it is the financial information that we provide is understandable. Okay, to make financial report understandable, it does not mean that we should exclude inherently complex and difficult to understand phenomena from the financial report. Okay, to make it understandable, meaning that if you don't understand certain things, it does not mean that you have to exclude the items. Okay, it could be complex, okay, it could be difficult to understand, but when the transaction happen, when the phenomena happen, so you have to report them. Okay, any financial information, okay, any business transaction that happen, you have to report them. Okay, regardless of the complexity of the information, because it is common that if you don't understand certain things, then you have to seek help, okay, from, or seek advice from the expert. Okay, all right, but we need to even though we need to achieve this understandability, but still we cannot exclude, okay, any complex or difficult to understand phenomena. We have to include everything, okay, but to make it understandable, maybe you need to provide more description, or maybe you could advise them to seek an expert, okay, to understand the phenomena. All right, because why? Because the report will be incomplete and therefore potentially misleading. Okay, all right, so next. Okay, there are accounting assumptions and concepts which are not mentioned in the conceptual framework, but we are going to discuss it here. All right, so let's look at the next one. Okay, so we're going to discuss on 4 accounting assumptions and concepts, starting from going concern. So this is a very important assumption when we prepare the financial statement, where we are going to assume that, okay, the business is going to operate, okay, or continue to operate in the foreseeable future. In other words, the business is going to operate forever. Okay, because if you have the assumption that the business is going to shut down, or the business is going to cease the operation in the following year, okay, then you have to change the way you prepare the financial statements. All right, okay, and then another concept is historical cost or cost concept. So this is where the assets, services, and liabilities are recorded at cost. Everything, okay, is to be recorded at cost, because cost is definite and determinable. Okay, provide objectivity. Okay, measure on cash or cash equivalent basis. So cost here does not only referring to the cash, to the amount that you to the money that you exchange with the seller, okay, but it can be cash equivalent. So cash equivalent here could be the present value of future value, okay, or it could be based on the yes, cash equivalent, okay, which is the present value. Okay, so you may record at this amount. Okay, all right, next. Business entity concept or economy entity concept. This is where we assume, okay, when we prepare the financial statement, especially for the sole proprietorship or partnership, okay, we must make sure that the items that we prepare, that we show in the financial statements, okay, the items are separate and distinct from the owner. Okay, items recorded in the books, in the business books, are limited to the transaction that affect the business only, and to exclude the owner's personal transaction. Okay, the owner may took the money from the business. Okay, so we are going to record, and then we're going to deduct from the financial statements. Okay, it does not mean that when the owner took the money, then you don't have to record. Okay, using this concept, it does not mean that when the owner took the money, then you say that, oh, we don't have to record that one, because we have to assume that the business and the owner are different. Okay, no, you have to record, okay, the amount that have been taken by the owner. Okay, but then we're going to exclude at the end of the day, okay, as drawing. All right, from the financial statements. Okay, all right, and then the next one is the money measurement. Okay, money measurement is where the items are to be recorded and reported in monetary terms. Okay, Ringgit Malaysia in case of Malaysia. And then we are going to assume that the purchasing power of Ringgit Malaysia does not change. This assumption is important when you make a comparison across period. Okay, because we, of course, we know there are so many factors affecting, like for example the inflation rate, okay, the change in the economy, but okay, but when we make a comparison, okay, we have to assume that the purchasing power does not change. Okay, the reason for using the monetary term, number one, is because it is a common denominator. It is an appropriate basis for accounting. Okay, and then for accounting measurement and analysis, and then this is the most effective means or changes in exchange of goods and services, the most effective means in recording the exchange of goods and services. All right, okay, so with that, okay, we have finished our topic 2, all right, on the conceptual framework. Thank you.